Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to continue our study on financial statement analysis, or what we call, analysis of financial statement, by looking at a very key topic called common size financial statement. Now, this is treated as part of interpretation of financial statement. Okay, we use it as a means to compare performances of two different companies that are not of the same size. Now look at the name, common size financial statement. Now we can have an industry where there are different sizes of companies. When we talk about size of a company, basically it's about the total assets or the total revenue generated. I mean, those are two parameters that can be used to determine the size of a company. If company A is able to generate revenue of, let's say, $3 billion, and company B, you have two companies. One generates revenue of $3 billion in a year, and then another company generates just about $200 million in a year as revenue. Now, these two companies obviously are not of the same size. Okay, company B is a smaller company as compared to company A. Company A, looking at the size of revenue, means that they are a very big company. That is what we mean by big or small. Now, another way you can compare is by their total assets. Let's assume that company A's total assets is around 30 or $40 billion. And then company B's total asset is just around $800 million. Now, these are not the same. Okay, this is in billions, this is in millions, this in billions, this in millions. So obviously you can see that company A is a bigger company relatively compared to company B. So these two companies may be in the same industry, one producing and selling more at economies of scale, and then the other producing at a small capacity. Now, regardless, so far as they are in the same industry, there should be a way of comparing their performance. If you look at profits to just compare performance, you may be making a mistake, because the profits of company B, even though small, might be relatively bigger in terms of percentage, which we call profitability. Another way that you can look at this is to prepare a common size financial statement. Now, the purpose of preparing a common size financial statement is to look at the various items on the financial statement as a percentage of either the total revenue or the total assets. So we are going to look at total revenue against total assets. Now, on the statement of profit or loss, the focus will be total revenue. On the statement of financial position, the focus is total assets. So what we are trying to say with the name common size is that we are trying to make these two companies, which are not of the same size, kind of comparable by bringing percentages onto their financial statement, so that we can easily compare that, okay, making revenue as the viewpoint on the statement of profit or loss, we will say that, let's say, expenses or operating expenses are maybe 30% of their revenue. And then for the other company, operating expenses are, let's say, 25% of their revenue. In that case, we have moved away from absolute figures onto relative figures. We have now been able to put the financial statement in percentages, which will make it easily comparable, so that we can easily determine which company is doing well or the other. Now, that is in case of situations where the companies are not of the same size. Even if they are of the same size, we can still use the same common size financial statement to compare performances. So let me tell you this, the essence of preparing common size financial statement is that we want to use percentages to compare the performance, and then we always need a yardstick to perform. And so when it comes to the performance statement of profit or loss and other comprehensive income, our point of reference is always the revenue. So all items on the statement of profit or loss will be compared against revenue to determine percentage of revenue that it is. So we can say that, okay, cost of sales is 60% of revenue, operating profit is 30% of revenue, net profit after tax is, let's say, 20% of revenue. That is what we say. So that if a company has a higher percentage of revenue as profit than another company, then we can say that they are maximizing returns from their revenue. In other words, they are minimizing their cost and then they are getting enough profit. So that even though the sales figures may not be the same, we can still use percentages to compare who is doing better or not. I'm sure this is understandable. When it comes to the statement of financial position, our point of focus will be the total asset. So we can say that, okay, company A's current asset is 40% of the total asset. Company B's current asset is 35% of the total asset. We can say that company A's long-term loan is 60% of their total asset, whilst company B's long-term loan is 40% of the total asset. When we make comparisons like that, it becomes easier to know who is efficient, who is doing well in terms of percentages as compared to total assets on the statement of financial position. So the essence of common size financial statement is to get an item of interest against the parameter of measurement. So in this case, if you want to look at the percentage of receivables for each of the companies, the item of interest will now be receivables over total assets times 100. So that is how it's going to be. If it's the statement of profit or loss and you want to look at the percentage of operating expenses, the formula is going to be operating expenses over the total revenue times 100. So these are basically what we are going to do. So we are going to calculate the percentages for each of the items on the financial statement, making total revenue as a denominator for the statement of profit or loss, and then total assets as a denominator for the statement of financial position. However, the items of interest is going to change, but the denominators remain constant across the common size financial statement. And so I'm not going to waste your time. This is practical. I'm going to just give you a financial statement, a small financial statement on the board for statement of profit or loss, and then we are going to calculate the common size financial statement for that. When we are done, we'll also write a simple one for statement of financial position, and then we'll calculate the percentages, and I'll show you how it's done, after which we can look at a complex question and then solve it together. Okay. All right, so like I said, I have written down on the board a sample financial statement that we are going to use to learn how to calculate these percentages and prepare the common size financial statement. Now, in preparation of the common size financial statement, even if the question has given you the financial statement, your job is that you definitely have to recopy the financial statement in your answer booklet, which I have done for you. So I have assumed that this is the question that we have been given to prepare common size financial statement on. Then you would create a column called common size. As a percentage. And that is where you are going to put your percentages. So let me put here common size as a percentage. Now, what we are going to do is that we are going to prepare a common size financial statement. Now, we are not comparing these two. Here, there are no two companies to compare. This is just an illustration to teach you how to prepare the common size financial statement. In a typical question, they can give you two different financial statements of two different companies that are not of the same size. So you prepare what I'm coming to do. You do what I'm coming to do by calculating the percentages to prepare the common size financial statements. Once you are done, then you can make your comments where it's necessary. Okay, so watch what I'm going to do. I've told you that when it comes to the statement of profit or loss, the point of reference is the total revenue. When it comes to the statement of financial position, the point of reference is the total assets. So the total assets always stands as 100%. The total revenue always stands as 100% because we are using both of them as the denominators. And then we want to know what percentage of the revenue is gross profit. What percentage of the revenue is the interest? What percentage of the revenue is net profit after tax? And in that manner, when we come here, we want to know what percentage of total assets is cash. What percentage of total assets is the PPE? So what we are trying to do is that we are finding percentages of total assets for each of the items on the statement of financial position. And we are finding percentages of total revenue for each of the items on the statement of profit or loss. So look at how we prepare the common size financial statement. I'm going to do it. So this is exactly what you do. You repeat your figures and then you create a column for common size. You repeat your figures and then you create a column for common size. Now, this is what I'm going to do. Revenue will be 100%. So I'll write 100% just in front of revenue on that same line because that is our point of reference. Revenue is always 100%. Now, when it comes to cost of sales is 12,000. So we want to find what percentage of cost of sales is the revenue. And so what is going to happen is that you're going to pick your calculator and calculate 12,000 over 20,000 times 100. This is how you're going to calculate it. 12,000 over 20,000, which is the total revenue. So cost of sales over total revenue times 100. And that is going to give you 60%. Okay, I'm just showing this. I'm going to clean the workings, but I'm giving you the approach of how to go about preparing this kind of common size financial statements. And so you come here on the line of cost of sales, just in front of the cost of sales, under the common size, you put 60%. That is what you do. When it comes to gross profit, you pick your calculator, you punch 8,000 over the same 20,000 times 100. So 8,000 over 20,000 times 100 is going to give us 40%. So you put 40% in front of the gross profit. The interpretation is that for this very company, their gross profit is 40% of their total revenue. Their cost of sales is 60% of the total revenue. That is what we mean by common size financial statement. We prepare this, you prepare for the other company, so that no matter how big your financial absolute figures are, we are now doing the comparison based on percentages, so that we will mean it's like we now reduce, even though we are not of the same size, but we reduce our sizes so that we can match in terms of percentages for easy comparison of performance. That is what we do. So when we come here, operating expenses will be 3,000 over the same 20,000 times 100. And that is going to give us 15%. So you put your 15% there. So you put your 15% there. Please remember that you can put these lines here to show. Okay, so please, I forgot to tell you that the lines must show. So right after you rule off and then you do the calculation. So it is like you are preparing the same financial statement, but this time it is in percentages. And then when we come to operating profit is 5,000 over the 20,000. So it will be 5,000 over 20,000 times 100. And that is going to be 25% of sales. Then we come to the interest. That is the finance charges. That is 1,000 over 20,000 times 100. And that is going to be 5%. So we put it here and then we can underline. After doing this, then we come to net profit before tax. That is 4,000 over the same 20,000 times 100. And that is going to give us 20%. So 20% of sales. Then the taxation is 1,500, the tax expense. 1,500 over 20,000 times 100 is going to give us 7.5%, and then you can underline. So your net profit after tax, which is 2,500, will be 2,500 over 20,000 times 100, and that is going to give us 12.5%. So this one, I have now converted the financial statement into a common size one, so that when I have another financial statement, I do the same for a different company, then we can easily compare the performance. I'm sure you really understand what we are trying to mean. So it means that you can look at the financial statement of this company and say that, okay, in all, the operating expenses covered 15% of revenue. So that if another company's own covered 10% of revenue, then you can advise this company that they should find a way to reduce the percentage of revenue that they are spending as operating expenses in order to stay competitive. I'm sure this is very understandable. So this is how to prepare a common size statement of profit or loss. The focus or the standard of measure is always the total revenue. It's always 100%, and then we find percentages of that. This is very simple. I don't think this should be a problem for you. Now, from there, we look at the statement of financial position. Now, I have told you that when we come here, the point of reference is the total assets. So total assets will always stand as 100%. Okay, the same as total equity and liability because it's the same amount. So now we are going to find percentages of all these figures on the financial statement of total assets, percentage of all these on total assets. So we can say that if PP is 15,000, then it's going to be 15,000 over 41,000 times 100. That is how we calculate for the non-current assets, the PPE, sorry. So 15,000 over 41,000 times 100, something like this. 15,000 over 41,000, and all of them will be over 41,000 because the total assets is 41,000. So it's going to give us 36.59%. Okay, I've left it in 2 decimal places. 36.59%. Then we take the investment property, which is 10,000 over 41,000 times 100. And that is going to give us 24.39%. So we can underline and find the percentage of the total non-current assets of the total assets. And so what is going to happen is that it's going to be 25,000 over 41,000 times 100. And that is 60.98%. So what we are trying to say is that we are not saying that after preparing this, all of them must add up to 100 necessarily, because there are some totals in there. But what is most important is that we can interpret for the fact that the property, plant and equipment covers 36% of total assets. The investment property alone is 24.39% of the total assets of the company. That is what we are trying to say. So that when we do this for one company, it will never make sense if you're analyzing it for one company alone. That is why it is common size. It makes sense if after doing this two for one company, you take another company and do the same for that company. Okay, so that when you are done, you can now compare the figures. That is if they are in the same industry. You compare the figures to know who is doing well or not. Now, when it comes to inventory is 6,500 Ghana cedis for this company. So it will be 6,500 over 41,000 times 100. And that is going to give us 15.85%. Then we come to receivables. Receivables is 4,500. So we divide by the 41,000 and we multiply by 100. And that is going to give us 10.98%. When we come to cash, cash is 5,000. We divide by 41,000 and then we multiply by 100. So the cash percentage will be 12.2%. And then we look at total non-current assets. So I can rule a line here. 16,000 over 41,000 times 100. That gives us 39.02%. Okay, so we have calculated for the assets. Now let's move to the equity and liabilities. When we come here, the ordinary shares is 23,000. So we'll say 23,000 over the same total assets, 41,000 times 100. I don't think this is very difficult, okay? I mean, this is very understandable. So the percentage is 56.1%. Now, when we come to retained earnings, it's 9,000. So over the same 41,000 times 100. That is going to give us 21.95%. Then we come to 32,000. 32,000 over the same 41,000. So I can rule my line to show total equity. Okay, so total equity will be 78.05% of total assets. So this is good. I mean, the total assets are financed from 78% of equity. Or let me say 78% of total assets are financed by equity, which is not bad at all. All right. Now, when we go to the long-term loan, that is 8,000. So 8,000 over 41,000 times 100. And that is 19.51%. Okay. And then the final one becomes payables. 1,000 over 41,000 times 100. And that gives us 2.44%. So ladies and gentlemen, this is how to prepare a common size financial statement. It is all about the percentages. So you repeat the financial statement in your answer booklet and then you calculate the percentages with the total asset as your point of reference for the statement of financial position, and then your total revenue for the statement of profit or loss. But like I said, if you want it to make sense, preparing for one company may not be enough. You need to look for another company and prepare, so that you can now begin to compare the percentages. So once you put them in these percentages, then you are putting them in a common size. They may not be of the same size in terms of their absolute figures, but the percentages will put them in a common size, so that you can easily make inference or make some conclusions on performances and efficiencies. That is why we call it common size financial statement. So this is just for one entity, but in a typical question that we are going to solve in the part 2 of this video, we are going to look at 2 different entities, and then we are going to prepare a common size financial statement, and then we can make our conclusions on various performance indicators. Okay. Now, what you need to also understand is that there are some advantages and disadvantages in using common size financial statement. Those are theoretical aspects, okay? For example, one advantage is that it becomes easier to compare firms of different sizes, okay? And then it is more realistic to use the percentages to compare than using the absolute figures. However, it has some limitations. That is, the limitations or the disadvantages could be that, one, different organizations may use different accounting policies, and then comparing their financial statement with different accounting policies may not really be accurate. Another limitation is that different financial statements or different companies may have different accounting calendars. It means that the figures from company A may not relate to the same period of that of company B, meaning that other factors such as inflation and changes in tax rules and other things or prices could affect the figures that you see, even the changes in foreign exchange rates, especially when it's a multinational company. So there are some advantages and disadvantages of using this common size financial statement. I would plead with you to go and take your time and read on the advantages and disadvantages of common size financial statement. When you discover, you can put some of them in the comment section so that all of us can learn together. Now, in the part 2 of this video, we are going to look at a complete question that involves 2 different companies where we need to prepare common size for each of them, and then we'll make our comments on specific performance indicators that we need to make comments on. Remember to subscribe to this channel if it is your first time. Share this video, let others also have a benefit. And until we meet again for the part 2 of this video or this lesson, it's bye for now. Thank you.